What if I told you there's a legal way to potentially save thousands in retirement taxes that 84% of retirees never use? The government doesn't come out and tell you this, but required minimum distributions aren't actually what's best for your retirement in most cases. They're about collecting taxes. JP Morgan found that 84% of retirees only take the required minimum amounts. In this video, I'm going to walk you through exactly how this matters for your retirement planning, how to analyze your specific situation, and the strategic approaches that consistently deliver better long-term outcomes. I'm Bob Wolf, certified financial planner and IRS enrolled agent. Quick disclaimer here, this is educational content that should not be misconstrued as specific legal or tax or investment advice. Let's start with what required minimum distributions actually represent. When you contributed to your 401k or traditional IRA, you received a tax deduction. This is a deferral. Many people think that they're getting a deduction. That is true, but it's ultimately kicking the tax can down the line. RMDs are simply the government's mechanism to ensure that those deferred taxes eventually get paid. The government wants their money back, with interest being the growth of the account throughout the years that it's remained invested until you're forced to take it out. And here's what's critical to understand. RMDs represent the minimum required to avoid penalties. They're not necessarily the optimal strategy. Think of it like this. The IRS is telling you the least you can pay, not what's best for you. It's like asking a car salesman what you should spend. And JP Morgan's study shows that 84% of retirees only take this required minimum, and that suggests that most people are treating this floor as a ceiling, potentially missing significant tax opportunities. In order to get a good framework of how this may work better, we need to understand that your ordinary income, required minimum distributions, wages, so on and so forth, gets offset by your standard deduction or itemized deduction first. Then, portfolio income gets added on top of that. This does create big opportunities for most retirees that they generally miss. So let me walk you through an example of an aggregate of what I often see. Meet John and Sarah. Here's exactly how they can realize nearly $130,000 in income while paying a whopping $0 in federal taxes. First off, in step number one is the standard deduction shield. In 2025, they would be eligible for $46,700 between a $31,500 standard deduction as well as the new additional temporary senior deduction of $12,000. This means that they can take the $46,700 from their traditional IRA and pay exactly $0 in federal taxes on it. That's right, completely tax-free. Step number two here is that to the extent that they need additional dollars or funding their lifestyle, maybe they ended up taking that amount as a conversion, they can now realize capital gains to fill up the next portion of the bracket. This is where it's super important to understand the ordering of income and deductions. Ordinary income is taken first, then our deduction of our standard are itemized, and then lastly our long-term capital gains and qualified income is added on top of that. For completeness here, they can take up to an additional $96,700 in long-term capital gains while still paying a whopping $0 in federal taxes. So the total here is the $46,700 taken from IRA withdrawals or conversions, $0 in taxes, $96,700 in capital gains, $0 in taxes, and they are still qualifying for the new temporary senior deduction, which is $12,000 in total, since their income is below the income limitation for that. For single filers, you can still realize roughly half of these figures using the similar strategy. So think about that for a moment. Most people are focused on minimizing their current year taxes, and they're missing this massive opportunity to be planning ahead, depending on what their income might look like when they're in their elder years. They're leaving potentially tens of thousands of dollars on the table. This is why understanding the tax code and the ordering matters more than just following the minimum rules. But timing here becomes absolutely critical. And so when does planning matter the most in the strategic timeline that we can think about? The current RMD timeline provides important planning opportunities, but only if you know how to use them strategically. Those born in 1950 or earlier, RMDs already started at age 72. Those born between 1951 and 1959, RMDs start at 73, and those that are born in 1960 or later have their RMDs start at 75. So what's particularly valuable about this timeline is that it gives you a couple of years, sometimes decades, to implement strategic income realization to make sure that we're planning and minimizing our lifetime tax bill before you're required to take the distributions. This is your window of opportunity that most people don't think about. One critical timing detail that trips most people up is that your first RMD must be taken by April 1st of the year after you reach the required age. Then by December 31st of each year after that. So if you delay that first distribution until April, you'll need to take 2 distributions in the 1 calendar year, which could push you into a higher bracket. It could also be strategic. I've seen this single mistake cost people unnecessary taxes. So let's walk through how RMDs are calculated, because understanding the mechanics of that helps you see the strategic opportunities. The way that your RMD is calculated is that you divide your December 31st prior year balance by the IRS life expectancy factor. And over time, our life expectancy decreases. So what that means is that our numerator is contingent on market fluctuations, but the denominator decreases over time, which naturally pushes up what we have to distribute from our accounts, all else remaining equal, assuming that our accounts are still growing over time. So the required percentages do increase with age, and at 73, it's just shy of 4% at around 3.77%. At age 80, it becomes 4.9%. At age 85, it becomes approximately 6.25%. At age 90, we're looking at an 8.2% distribution to realize an income if it's a traditional account at that point in time. So this system creates variability in your required distributions based off of market performance and our longevity, which may not align with your actual cash flow needs or tax optimization opportunities. So what should you do instead? Here's where it gets powerful. If we look at things from a lifetime tax approach and not just how much can we save on taxes this year, last year, next year. Rather than planning year by year, the most effective approach I've seen involves mapping out your expected tax situation over your entire retirement. And of course, the crystal ball gets fuzzier as we get further out, and that's where scenarios come into play. This means considering Social Security beginning, when a pension might start, when your mortgage might fall off, or how these changes affect your tax brackets over time. Most people plan 1 year at a time, but wealthy families plan decades ahead. For example, many retirees have a period between when they stop working and when Social Security begins, where they're in relatively lower tax brackets than they were in their highest earning years. This is what I like to call the golden window for tax planning. And that's where that $140 some odd thousand tax-free income strategy becomes incredibly powerful. Here's how smart retirees use this window. They take advantage of those lower tax brackets to do either systematic withdrawals or conversions, even if it means taking more than they might need for their current expenses. You're essentially buying future tax savings at today's lower rates. But there's an even bigger issue that most couples never see coming, and it could have negative impacts on your retirement plan. And this has to do with those that are couples. So for those of you who this doesn't apply to, you could skip this section. But one aspect of retirement planning that deserves attention is how tax situations might change when one individual prematurely leaves this earth with a surviving spouse. Married couples could benefit from joint tax brackets, which are roughly double the single bracket. So when one spouse passes, the survivor often faces the same income level, but with single taxpayer brackets. So this becomes a concern for those that have an increasing amount of potential life expectancy, and that might impact people's effective tax rates jumping from anywhere from 12% to 22% overnight with the exact same income. This is why strategic planning comes into play and really helps with the distributions we might have to take. So what strategies actually work? Let me show you the 4 approaches that consistently deliver results here, and I'll tell you which ones are more important. First being strategic early distributions. If you're in those lower tax brackets now than you expect to be later, consider realizing income sooner than later to fill up those lower brackets, even if it's more than you need for your current expenses. Think of it like buying future tax savings at a discount. Strategy number 2 would be making precise Roth conversions and running the math on whether or not it makes sense for us. This is particularly valuable for married couples and those that are in the higher wealth spectrums to optimize their wealth for their surviving spouses and their heirs in the future. This strategy, however, does require careful analysis, as there may be other implications in your plan that might not be considered at first glance. The next strategy is charitable distribution strategies, and this is a win-win. If you're charitably inclined, qualified charitable distributions allow you to donate up to $108,000 in 2025, or double that if you're married and both qualify, if you contribute and you are over 70 and a half. This counts towards your RMD requirement and doesn't increase your taxable income. You're giving to charity while reducing your taxes simultaneously. Strategy number 4 would be income timing optimization. So looking for years when you might have unusually low taxable income due to larger deductions, charitable giving, or other circumstances. These can be excellent opportunities to accelerate our distributions. Sometimes the best time to take money out is when you might least expect it. The key to successful implementation is understanding that this isn't about following a one-size-fits-all approach. Every family situation is different, health insurance considerations are different, and what works optimally for one family might not work for another. Tax laws change, family circumstances evolve, and market conditions vary. The most successful retirees I've worked with review and adjust their strategies regularly rather than setting them once and forgetting about them. The families who get this right don't try to do it alone, and the investment in professional guidance pays for itself many times over in circumstances where it's integrated. So what should you do next? Here's the action plan that I would think about in the right order. Step number 1 would be mapping an assessment and mapping our expected income sources and tax brackets over the next 20 to 30 years in the best possible way we can forecast them. Consider Social Security timing, pension benefits, other factors, inheritances that might impact your tax situation. You need to see the whole picture before making any moves. This is where that 140 some odd thousand tax-free opportunity starts coming into a clear picture. Next up is the analysis. Run projections comparing different distribution strategies. Look at the lifetime tax implications, what that might impact for our healthcare subsidies and costs, not just the current year impact. Don't make decisions based on this year's taxes alone. Think decades ahead. The next step I would recommend is working with qualified professionals who can analyze your specific situation and help you implement strategies appropriate for your specific circumstances. This is where good advice for itself pays many times over, and I've seen proper planning save families hundreds of thousands of dollars over the long term, increasing their ability to live a joyous life and also increase their ability to leave a legacy. If you're looking for additional help in analyzing how these strategies might apply to your specific situation, I've included a few links in the description below for resources that can provide additional guidance. Remember, this type of planning works best when it's customized to your situation and adjusted as life changes. The resources can walk you through what to look for in your situation. If this analysis opened your eyes to retirement distribution opportunities that you were not necessarily aware of, I'd appreciate if you give it a like and a subscribe. I regularly share insights on retirement and tax planning strategies, always with the goal of helping you make more informed decisions about your financial future. Thanks for watching, and remember, the best retirement strategy is the one that's designed specifically for your situation and goals. Don't let the government take more of your money than they legally deserve.